All right, so I just did a video talking about an article from MarketWatch or something about clickbait headline about this is the number one signifier, is that the right word, about future stock performance. And actually the article said it's variability of performance, not performance itself. Anyway, and I use that showing how a lot of people use this Brinton study from 1987 about pension funds that showed that 92% of performance of stocks has nothing to do with security selection, but in terms of just being in stocks versus bonds versus cash. And I said that wasn't what the Brinton study said. It said the variability of performance was due to that, not the actual performance itself. And all these guys in my industry ran with that to try to validate their fees with a big fat nothing burger, because that's not what that study said by Brinton. So now that cat has been let out of that bag, you don't really hear, at least I don't, maybe it's still out there, I don't hear too many people anymore arguing using that Brinton study wrongly. I imagine still people are. Part two of this is the Dalbar study, the infamous Dalbar study, which even I was suckered into, not by Dalbar, they didn't sucker me into, but just it led me to show people why they needed me to pay a fee, when in hindsight that study was fake too. So, fake. It's a real study, it's just completely misleading. So the Dalbar study says the average investment makes 8%, the average investor in that average investment makes 5 or something like that. So you have the S&P 500, the average on the S&P 500 is 8. Josh, you own the S&P 500. Josh's return is 5. Why is that? And they say it's because investor Josh's behavior. I get out when the market's low, and I get back in when the market's high. Essentially saying, I have emotional mind of a child and can't deal with the up and down of the market. As because of that, I hurt myself as an investor. Thus, the result would be I should turn over my investment management to a third party and pay him a fee to keep me from making that, quote, big mistake, unquote, which is getting out when the market's low and getting back in when it came back up. In my experience, that just doesn't happen very often with investors. It just doesn't. It does. Talked to a couple not too long ago. They got out in March and they're getting back in gradually now. It stinks. Does happen. I'm not going to lie about that. Talked to another couple in Arizona in March, got a big cash component. I said, man, what's that about? They had a guy over at Charles Schwab, put them all in cash, like at the end of March. I was like, when are they gonna get you back in? I said, I'm not sure. So I said, you gotta call this guy. What's going on here? How is this part of a long-term investment plan? Well, it wasn't. And so the guy at Schwab, trying to stem the bleeding under his watch, where he's charging, 1% or 1/2, whatever he was, he got out because he said, I can't. He capitulated, which is absolutely a good sign of the market bottom. And sure enough, that was the market bottom. And then he got back in. Now, thankfully, he got back in quickly enough that he didn't miss a 30% run-up that we've had since then, but he missed a good amount of it, probably 10%. So at the end of the day, my argument has always been, and forever will be, it's not the individual investor who's a nervous Nelly, it's the investment management professionals. Because their whole point is to keep you from getting hammered. That's what they make. They say active management, you pay active management not when times are good, but when times are bad. In fact, I was just reading an article from Advisor Perspectives where the guy made that exact claim, which I kind of thought was funny. So I said, oh, okay, so that's our new argument, that active management works when not when times are good. You might as well just have the index, but it's when times are bad when active management earns its keep. I said, okay, it's interesting. That's now the flavor of the month to validate paying high fees for investment management. So I like to see that because my experience is this is absolutely not true. Be it as it may, so the Dalbar study says essentially the average investment made 8, the average investor made 5. Thus, the average investor doesn't know what he's doing, and essentially we need to take away the keys from this teenager. The problem though, there's so many problems with Dalbar. Time-weighted returns versus actual investment-weighted returns. So essentially they're saying the Dalbar study would go 20 years in the past, say $100,000 in the S&P 500 was, we started 2000, $100,000. You just let it sit there at the end of 2020, it's worth $300,000 just for simplicity. Thus you average whatever that is, 8% a year, something like that. I guess 7.2% a year, but I just want to say 8 for simplicity. All right. Now the average investor though, he doesn't have $300,000. He only has $230,000. And you're like, whoa, oh my goodness, that's proof positive, right? No, it's not. Because the average investor is putting money in on a regular basis, taking money out, putting money in, taking money out to spend, put money into a dollar cost average. Thus, we're not starting at the same time frames. And there's other things wrong with the Dalbar, by the way. We're not starting at I guess we are starting at 2 consecutive time frames, but essentially what we're saying is how much return did the average investor get starting in 2000, where the S&P 500 got 8%, how much did that average investor get? And you'd have to look at the individual investments over the course of time. You say he started with 100,000 or whatever it is, or he started with 50,000, it doesn't matter. But he's putting in $50 a month. He's putting in $100 a month for 20 years, and thus his return is only 7.2 or whatever it is. You see what I'm saying? Because it's completely 2 different things you're measuring. One is a static average rate of return, and one is a money-based rate of return. You got time-weighted returns, and I forgot what it's called. But there's another return you got to look at: your contributions, your withdrawals, and stuff like that. So in this case, you don't have 20 years of full investments in there because you've been adding to it and taking money out over those 20 years. So an investment made in October 2007 inherently is going to be worse than an investment made in March of 2009. Whereas the S&P 500 as a whole just shows the average. But people use this Dalbar study to validate that you need me. And it's nuts. And I think, well, again, I don't really follow anymore what the investment money management folks are using in their sales pitches. My assumption is they don't use Brinton study because that's just silly. My assumption is they don't use Dalbar anymore because that's just silly as well. But I don't know that to be true. I don't know that to be true. So, if someone's using a Dalbar study, run for the hills. If someone's using a Brinton study, run for the hills. Similar if someone's using a 4% Trinity study, 4.4, run for the hills. That study's not a nothing burger. There's validity to that study, but it has nothing to do with you. Specifically, nothing at all. If they're using these studies to try to separate you from investment management or to get them to be your investment management, I say, no, these studies aren't valid to me as an individual investor because they're just not. On top of that, the Dalbar study, of course, doesn't show fees that you'd have to pay to an investment guy anyway. Crazy. And it doesn't say the difference is if the average investor versus the average investment, is the average investor including accounts that are managed by money managers? We don't know. But if they're using that, you just got to say, nah, that's now what they're using, the evidence-based investing stuff. That's from DFA, Dimensional Fund Advisors. A lot of these guys who are a little bit more students of the business than just average Joe Schmo who've now been taken on the chin because Brenton, you can't use that. Dalbar, you can't use that, have now gone into DFA stuff, especially after the aughts, because DFA, when it comes to not cap-weighted indexing, factor-based investing, equal-weighted indexing and stuff after the aughts looked pretty good relative to cap-weighted. Value-weighted stuff looked real good relative to growth in the aughts, and now it doesn't look so good anymore. So you hear the guys from DFA, who I like, but they're taking on the chin because the last 10 years they've underperformed. And so now what we're seeing here is what worked to argue for you paying a money manager with evidence-based investing using the factor models of French and Fama and dimensional fund advisors and whatnot. Those days are not looking as good either, because those models, I don't even want to say broken, but they're just underperforming over the last 10 years because everything, growth and value. 10 years from now, when value outperforms, people will be looking back and saying, those guys are right. DFA was right. But how many people stay in there? Who knows? That's the issue. So my argument is always, just buy the freaking index and be done with it. Save your fee. Hire some guy for financial planning, like me, or I don't care, someone at Garrett Financial Planning Network, someone who charges a fee for financial planning as opposed to AUM, assets under management. Don't pay for investment management. It's a net loss, man. The only person who wins in investment management fees are the firms, not you. All right, we'll see you.